Hello and welcome to India Tonight with me, Ankur Mishra and Nivedna Prabhu. In next 1 hour, we'll touch base all the important news of the day. But let's get started with the one more rating upgrade which has come for India. The global confidence in India showed in the rise as in the third ratings upgrade in 2025. Japan's rating and investment information has upgraded India's long-term foreign currency issuer rating to BBB plus from BBB. With a stable outlook, the move comes closely in the heels of rating outlook by DBRS in May and S&P Global last month, and not to forget, even Fitch maintained India's rating.
Absolutely. In fact, Ankur, as you put that into perspective as well, let's tell our viewers that RNI has highlighted India's economic fundamentals, robust growth prospects and resilient external position as the reasons behind the upgrade. In fact, this move is expected to boost investor sentiment and reaffirm India's position as a stable and attractive investment destination. But what does he make of this and what for can we decode as far as that's concerned? Let me take the opportunity to be introducing our guest this evening, Siddhartha Sanyal, Chief Economist and Head of Research, Bandhan Bank, joining us on the show. Mr. Sanyal, thank you very much for joining both Ankur and I and our viewers as well. Let's begin with essentially what do you make of it initially?
Thank you, Ankur. Thank you, Nivedita. I think this is no surprise. India is actually witnessing a phase with pretty stable macro fundamentals, pretty positive macro fundamentals compared to many other economies globally. Especially the larger economies, it actually enjoys a pretty strong momentum. Admittedly, there is a lot of uncertainty in the global economy in terms of geopolitics, in terms of tariff policies and economic policies in general. But having said that, India has a very strong domestic economy focus, and the current external developments are actually pushing Indian policymakers to go for a speedier path in terms of delivering some of the reforms, which is more domestic focused and will actually put India on a stronger footing going ahead. So I'm not really surprised that global rating agencies are actually recognizing this particular factor, and we are witnessing one after another rating upgrades for India.
This side, and of course it is not a surprise, but everybody was caught surprised when India posted Q1 GDP numbers at 7.8%, and after that there has been series of positive news as well. I want to understand with you first, will there be more rating agencies who will follow a similar kind of trend after 3 of them have already done so? And which are the next positive economic triggers per se which will force them to do so?
Well, I tend to say that, yes, in case of India, in many of the quarters of late, there had been GDP numbers which were better than what the market had expected. My sense is that what we may see going ahead, at this moment, we are seeing some bit of uptake or turnaround in certain segments of consumption. Also, low inflation leading to higher disposable income in the hands of people, as well as low tax burden going ahead due to lower GST will possibly be adding to that particular momentum. So my sense is that consumption will see some bit of additional momentum, which was not the case in some of the quarters earlier. That will act as some kind of a support. And also, while there is a lot of uncertainty in the global economy and in the tariff regime, we should not lose sight of this particular fact that India over the course of the last few years have actually moved significantly on the value chain of its exports. So it's not so easy for India to be a pushover in case of the global exports market as well. So my sense is that overall we'll maintain a pretty decent growth momentum. I'm not too sure that the 7.8 or anything above 7 will be maintaining, but even if we maintain something somewhere in between 6 to 7% kind of a number, or maybe a high 6% kind of a number, it should be seen as a very, very good number. And more importantly, India's this particular growth is not coming on the back of any major stimulus package, no major monetary stimulus, no major fiscal stimulus. It's coming more from fundamental factors of the economy, which is the bigger point in strength. And all the macro fundamentals, such as inflation, current account deficit, fiscal deficit, overall debt level, all are at very healthy levels. So we have all the health parameters in a pretty decent zone and actually growing muscles without using any steroids.
Right, Mr. Sanyal, fair enough, given how you're looking at it from your vantage point. But let me ask you this to understand. Do you think, in a sense, when you're looking at this entire situation, which specific domestic policies or reforms do you think was the most instrumental in this rating action that we're looking at?
I'd request you to repeat some part of the question I missed.
If you can hear me now, given what we're looking at, and also with the fact that, just the global rating agencies, in terms of how they've upgraded India thrice in just this year, what I want to understand from your perspective is which specific domestic policies or reforms do you think were the most instrumental in this rating action, Mr. Sanyal?
Two things I tend to say. One is strong growth momentum without any stimulus. First, that actually underscores the strength of the core strength of the economy. I think in a situation like this, an economy which is showing very strong strength in terms of its domestic activity should give a lot of confidence to all commentators, all rating agencies, all investors at this juncture, which India enjoys. India possibly enjoys much more than anyone else. And also, some of the initiatives that we are taking in terms of speeding up our bilateral trade agreements, as well as changes and tweaks in important changes in the indirect tax regime, I think these two should be giving a lot of confidence at this moment.
Right. Mr. Sanyal, one of the important events which is coming up next week is the GST rate rationalization, and RNI in their report has mentioned that while the tax change will result in revenue loss due to tax rate reduction, the negative impact will be offset to some extent by stimulation of private consumption. Now, this has been some kind of a pain point if you talk about in the last 1 year or so. Do you think that private Capex is also likely to be in a better scenario compared to what was there in H1 this year?
I tend to think that the big momentum in private Capex may still take some time. I'm not overtly optimistic on that particular aspect. What typically happens in terms of capacity utilization, where we are in the mid 70s kind of a zone, 75% odd at this moment, I think with the kind of uncertainty globally we are seeing, till the time the capacity utilization hits somewhere around in the zone of 85% or even 90%, people will go a little slow. I don't think there will be too much of an excitement in terms of jumping onto private Capex, but it looks like the momentum in consumption should eventually start moving us or pushing us towards that particular zone sooner than what we had been anticipating earlier. So to that extent, it should be positive. But if you ask me that whether in the second half of the year itself, private Capex might be a game changer, I'd rather be somewhat more conservative in my assumptions at this moment rather than going for very aggressive assumptions.
Mr. Sanyal, as you put that into perspective, what I just want to draw your attention to also, given what we were talking about earlier about the global uncertainties as well, and with how RNI has cited robust growth prospects and a resilient external position as reasons for the upgrade as well. But talking about the growth story for India, how sustainable is that in the medium term, especially in the context of what we're currently looking at globally?
I think India, even on the medium term, is on a very, very, very strong footing. The point at the cost of repetition, I'd like to highlight that major macro fundamentals, which historically had been some kind of pain point for India 10 year, 20 year back, compared to that, we are doing much better on those factors, such as managing inflation, managing our fiscal deficit, managing our current account deficit. On all those big health parameters, we are doing very well. If you see the government's policies, not only keeping the fiscal deficit low, they are very focused in terms of managing the debt level. So India is doing very well on those particular factors. As I had mentioned earlier, we seem to have moved significantly high up on the value chain so far as our manufacturing exports are concerned, and very clearly even on the services export side. Our services export surplus is very sizable, and you cannot rule out a situation a few years down the line if India more often than not start hitting a current account surplus also, which had not been that frequent in the past. So overall, we stand on a very, very strong footing so far as macro fundamentals are concerned. The demand from the domestic economy is strong. That should also help. I think some of the factors we need to be slightly more cognizant about as we move higher on the growth ladder. Something like how exactly climate and environment related risk we start dealing with. Uh, this kind of things, I think, eventually we need to be slightly more cognizant about. We see a lot of corporates turning a lot more focused and cognizant about this, so that shows that that awareness is also rising. So overall, there are reasons to be reasonably positive and optimistic.
Mr. Sanyal, but all eyes are also there on Reserve Bank of India policy, which is there next month. Uh, how much of an impact do you see? First of all, do you think there is going to be a growth rate revision by Reserve Bank of India, considering the first quarter number has been much above what was projected earlier? And more than that, how much of impact does the policy have these kind of ratings upgrade?
Sure. I think here also taking some kind of a slightly more conservative stance. They might still would like to wait a little more to judge the situation. I don't really pencil in any upward revision in growth at this particular moment, but generally the growth momentum still remains pretty healthy. If we eventually hit somewhere in the mid 6% zone in a year like this should be seen as something very, very positive. And I don't see a reason why the Reserve Bank of India should be in a hurry to revise that at this juncture.
Stay with us because there is an important quote which has come in from Anish Shah, M&M, and the third sovereign rating upgrade for India is just 5 months, is a strong vote of confidence in India's economic resilience and growth trajectory. That's what he's saying. He also mentions the recognition by RNI following S&P as well as Morningstar DBRS earlier this year reaffirms that India's robust macroeconomic fundamentals, prudential fiscal management and sustained reforms are being acknowledged globally. And indeed, that is the situation, and that is what we are addressing. Mr. Sanyal, coming to the debt position, even RNI has been mentioning that India's debt position has become quite sustainable as far as the fiscal deficit is concerned, which they are saying that it is likely to be contained at the targeted 4.8% of GDP. And overall, even the negative impact of GST rate revision, which government has pegged at 48,000 crore, is going to be offset by the other things, the consumption in the economy. What is your assessment overall on the inflation front, if at all this GST rate revision will have, and the offsetting of the negative impact of GST rate rationalization?
Yeah, valid points. I think the way we should look at it, that in case of, as we mentioned earlier, the capacity utilization in the economy, in the manufacturing sector, is still about 75%. So even if because of the GST cut, consumption gets a very significant boost, then also there is a bit of a catch-up game or a bit of headroom that Indian manufacturing industry enjoys at this moment, number one. Number two, global commodity prices are relatively at a benign zone. So overall risks to inflation is relatively limited. If at all, if the benefits of a GST rate cut are passed on immediately by companies, that might actually lower the inflation numbers statistically for the next 12 prints before they get normalized again. So I don't really see too much of a risk on the inflation front at this moment, barring any unforeseen big weather shocks or something of that sort. My sense is that this inflation numbers will be at a pretty decent and comfortable zone. So far as the fiscal deficit and the revenue loss is concerned, yes, there will be uh, a bit of revenue loss on the part of the government, but at the same time, as you also mentioned, the uptick in activities might actually provide a bit of a buffer. Also, given that there is some additional buffer the government is building over the course of the last few months, when some of the prices like oil prices, etc., had been moving lower, but not passed on to consumers to that extent. Some bit of buffer kitty that the government has built. This kind of things come very handy in a situation like this. So overall, neither on inflation nor on fiscal deficit I see too much of a risk in the very near term. If at all, inflation numbers might actually see some bit of statistical softening for the next 12 monthly prints.
It's a very imperative point that you make there. But do you foresee this upgrade translating into tangible policy shifts or fiscal discipline enhancements, Mr. Sanyal?
Oh, fiscal discipline has been a big focus of the government for a fairly long period of time. And I think that is giving a lot of rating agencies the confidence. Also, very important to note, now India not only offers a fiscal deficit target and almost invariably sticks to that, or does better on that particular aspect. Now the finance minister actually provides a glide path or a target for how exactly the government wants to bring the public debt to GDP ratio also over a period of time. This is particularly important because globally, if you see, public debt to GDP ratio has been on a rising trajectory for a lot of countries, uh, in both developing as well as developed economies. Against that, while India had some kind of a uptick in debt to GDP ratio immediately after COVID, that has started moving lower, and the government is actually indicating very strong commitment on that particular aspect. That should definitely give a lot of confidence to a lot of rating agencies and to investors globally who are watching India.
Right, Mr. Sanyal. On that note, I want to thank you very much for joining both Ankur and I, and also our viewers tonight, to essentially see from your vantage point how you're looking at this.